What if I told you the next big economic shock might not come from the stock market or the bond market, but from a single industrial metal? An element that's quietly, and I mean quietly, disappearing from the world's vaults just as an absolutely unstoppable wave of demand is getting ready to crash down on it. Welcome to the Bullion Signal Podcast, the channel where you look at the macro trends, precious metals, and the signals that can help you protect and grow your wealth. If you appreciate this kind of deep dive, do me a favor and hit that subscribe button. It really helps us out. Today, we're not just looking at some wild prediction. We are dissecting a fascinating argument based on a historical pattern, a four-act play that, according to our source material, has been the blueprint for nearly every commodity crisis in history. And the core of that argument? Well, it's that for silver, we are already deep into Act 3.
This really gets to the heart of the entire thesis. It's the idea that in certain markets, pressure just builds and builds, quietly, for years, right under a surface of what looks like total calm. And then, when a trigger finally hits, you don't get a gentle adjustment. No, you get a catastrophic release of all that stored up energy. The price doesn't just climb a staircase step by step. It's more like it gets launched out of a cannon. Today, we're going to explore exactly what's building that pressure in the silver market and what could be the spark that lights the fuse.
So you might be asking, how can anyone make such a bold claim? Well, this isn't about gazing into a crystal ball. It's all about pattern recognition. The argument here is that markets for physical things, stuff you can actually hold in your hand, like oil or grains or metals, they don't behave randomly. They are governed by the raw physics of supply and demand, and they're also governed by timeless human emotions, like complacency and eventually panic. And when those powerful forces collide with real-world physical limitations, they tend to unfold in a very predictable sequence. What we're doing today is identifying a blueprint for how markets break.
So let's lay out that blueprint. I want you to think of it as the 4 chapters in the story of every major commodity shock we've ever seen. Understanding this mechanism, this is the absolute key to understanding why the source material claims silver is in such a precarious position right now.
Okay, so here it is. It always begins with stage 1, complacency. The resource is cheap, it's seemingly everywhere, and entire industries are built on the assumption that it's always going to be that way. Then boom, you get stage 2, the demand surge. Some game-changing new use for the commodity appears, something the system just wasn't built to handle, and crucially, supply just can't keep up. This slow burn leads directly to stage 3, deficit recognition. This is the uh-oh moment. It's when the insiders, the big industrial users, start looking at the warehouse data and realize the shelves are emptying, and they realize the shortage is structural, it's not temporary, and that quiet behind-the-scenes realization, well, it inevitably leads to stage 4, panic. The secret gets out, everyone rushes for the exit at the same time, and the price, it detonates.
Now this right here, this is the secret ingredient. It's the linchpin for this entire crisis recipe, something called inelastic supply. Look, for most products, if the price goes up, someone, somewhere, will figure out how to make more of it to cash in. But what if you can't? What if it takes a decade and billions of dollars to build a new mine? Or what if the supply of what you need is physically chained to the production of something else entirely? That is inelastic supply. It's the fundamental bottleneck that prevents the market from healing itself, and it's what sets the stage for a truly violent move in price. A pattern is just a theory until you can see it play out in the real world. So to really test this framework, we have to look back at history. And what we find is this exact 4-act play showing up in some of the most dramatic commodity shocks we've ever lived through.
Let's start with the classic case study, the oil crisis of the 70s. After World War II, the entire world was completely complacent with cheap, abundant oil. That was stage 1. Stage 2 was this explosion of car ownership and suburban life, happening at the exact same time that U.S. domestic oil production quietly peaked. This created a massive, hidden fragility in the system. The 1973 OPEC embargo, that was the trigger for stage 3.
A sudden, terrifying recognition that the supply was not infinite and was controlled by others. And the result? Pure stage 4. Gas lines stretching for miles, economic chaos, and a tenfold price detonation. The pattern played out, step by step, just perfectly.
Now, for a more recent echo, just look at palladium. For years, it was a pretty boring industrial metal. That was stage 1. Then, tightening vehicle emission standards created this massive, new, non-negotiable demand for it in catalytic converters. That was your stage 2 demand surge. But palladium has a fatal flaw. Its supply is highly inelastic, as it's mostly a byproduct of nickel mining in just a couple of countries. So the market ran huge deficits for years, draining inventories. That was stage 3. And then came stage 4. The price absolutely exploded by 600% as automakers panicked, scrambling to secure whatever physical ounces they could find. You see, it's the exact same script, just a different commodity.
The source material even points to a much darker moment in history to make a really crucial point. During the Great Famine in Ireland, food technically existed in the country, but the failure of the primary potato crop caused the price of all other available food to spike so violently that it became utterly unobtainable for the average person. The lesson here is critical. A massive price dislocation makes a resource just as unavailable as a physical shortage. The price itself becomes the barrier. Remember that.
Okay, so we have a blueprint for a crisis, and we've seen it play out again and again throughout history. The entire argument we're examining today is that silver is following this exact script right now. And according to the source, it has just crossed the threshold into the most critical phase, stage 3, deficit recognition. So let's dig into the evidence.
Here's stage 2, the demand surge, happening right before our eyes. The global green energy transition. This is not a suggestion, it's not a trend, it is mandated by governments all over the world. And you simply cannot make efficient solar panels without silver. As you can see, the demand from just this one sector is on track to more than double in only 6 years. This isn't a normal cyclical trend. This is an exponential, policy-driven demand shock being forced onto a historically small market.
So the obvious question is, why can't supply just ramp up to meet this new demand? And this chart brilliantly illustrates silver's Achilles heel. A staggering 70% of all the silver mined in the world isn't from silver mines. It's a byproduct. It's what gets dug up when miners are really chasing copper, lead, and zinc. This means silver production isn't primarily driven by the price of silver. It's driven by the demand for industrial base metals. You can't just flip a switch and get more silver. The supply is structurally, fundamentally inelastic. All right, so now for the evidence of stage 3, deficit recognition. First, look at the inventories. They are vanishing. According to the source, the amount of registered silver that is actually available for delivery in the COMEX warehouses has plummeted by over 60%. And let's be clear, this isn't just a number on a spreadsheet. This is the real physical stockpile being drained away. The shelves are getting bare. And this isn't some one-off event, some statistical blip. The industry's own data authority, the Silver Institute, has now confirmed 3 consecutive years where global demand has massively outstripped total annual supply. Let me say that again. For 3 years running, we have officially been consuming far more silver than the entire world produces. We're filling that gap by draining those inventories we just talked about. That is the literal definition of an unsustainable structural deficit. So, what's the result of all this? The crucial point is that the smart money is already reacting. The big industrial users, the companies that actually need physical silver to build solar panels and electric cars and electronics, they are reportedly getting very nervous. They see the writing on the wall. They are starting to bypass the paper markets and are quietly trying to build their own private stockpiles to make sure their assembly lines don't grind to a halt next year. This is classic stage 3 behavior. The insiders are getting worried. So, if we really are in stage 3, and if this historical pattern holds true, well, we know what comes next. Let's move on and look at how this all builds to the final act, the panic and the price detonation.
The argument is that the trigger for stage 4 won't be some complex financial event that no one understands. It'll be a simple, terrifying headline. I want you to just imagine a major automaker or a giant solar panel manufacturer on their quarterly earnings call, and the CEO has to admit that production is being delayed because they cannot secure enough physical silver at any reasonable price. Can you imagine? That's the moment the quiet insider problem becomes a very public panic. Every other industrial user would immediately scramble to hoard whatever supply they could find. The race for the last few physical ounces would be on.
Now, this is the logical question, right? This is what you should be asking. Markets are supposed to be efficient. Surely, if the price gets high enough, it will create a solution. It'll provide some kind of off-ramp before we get to a full-blown panic. Well, the source material we're looking at today argues that in this very specific case, all the usual escape routes are actually dead ends. Let's walk through them. First, can't we just substitute it with something else? Not really. Not without a huge loss in efficiency. You just can't cheat the laws of physics and the periodic table. What about recycling? Well, most silver is used in such tiny amounts that it's not economical to recover. And the silver that's in solar panels, it's locked up for 25 years. Okay, so can't we just mine more? Well, it takes nearly a decade, sometimes longer, to permit, finance, and build a new mine. The deficit is happening today, not in 2034. And finally, the most important one, won't a super high price just kill demand? Probably not, when that demand is mandated by international law and backed by literally trillions of dollars in government subsidies for the green energy transition.
So when you boil it all down, the entire thesis is that silver is trapped in a perfect storm. It's a collision of three massive, independent global forces all hitting this tiny market at the exact same time. First, you have an exponential, non-negotiable demand shock from the energy transition. Second, you have a backdrop of persistent inflation and record government debt, which is driving more and more investors towards tangible, hard assets for protection. And third, you have a deep structural supply crisis with that inelastic production profile and absolutely no quick fixes. Any one of these forces would be incredibly bullish for the price. The argument here is that all three converging at once, well, that creates the perfect setup for a stage 4 event.
And that brings us to the final critical question that this analysis leaves us with. We've laid out a historical pattern that appears to be remarkably consistent across time and across different commodities. We've seen the evidence presented that this exact pattern now appears to be unfolding in the silver market, and it's being supercharged by an unprecedented, policy-driven demand shock. Now, the purpose of this analysis today wasn't to tell you what will happen, it's to give you a framework, a different lens for understanding what could happen. When a predictable blueprint for market failure meets an unstoppable modern force, is the outcome inevitable, or is this time truly different? That's the question this analysis leaves us all to ponder. I hope you found this breakdown valuable. If you did, please hit that like button and share this with someone who might find it interesting. And make sure you're subscribed to the Bullion Signal podcast so you don't miss our next deep dive. And just a quick reminder, this content is for informational and educational purposes only. It is not financial or investment advice. You should always conduct your own research and consult with a professional before making any investment decisions. You are solely responsible for the choices you make. Thanks for listening. We'll see you in the next one.